Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from ChartsandMarkets.com runs down the major markets. There are hints we could see a Santa Claus rally. He checks out gold, crude, the U.S. and Canadian dollars, and also uranium. Ross also has a special offer for our listeners. InsideTrackTrading.com President Eric Hadik looks into the cycles connected to bonds, the U.S. dollar, China's economy, and a so-called sweet spot for silver. Publisher of the Campbell Real Estate Timing Letter, Robert Campbell, tells us about the 5 indicators he uses to make his accurate forecasts and the biggest mistake real estate investors make. At the end of the show, we'll have a company showcase update from RecycLiCo CEO Zarko Meseldzija. We'll talk to Ross Clark right after this.
RecycLiCo, making lithium-ion last forever. RecycLiCo's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. RecycLiCo Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMY.ZF, and Frankfurt ID4. For more information, visit RecycLiCo.com or phone us at 778-574-4444. RecycLiCo, making lithium-ion last forever.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from ChartsandMarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to This Week in Money.
Always good to be with you, Jim.
Do we have a special offer for our listeners?
Yeah, we're holding on 25% off the annual subscription, and that's good through the Thanksgiving weekend. Thanksgiving's coming early this year in the U.S. I mean, I don't think you can have it any earlier than this. It's always the last Thursday in November, so the 24th, and we'll extend this right through that weekend. And we are in one of the very good seasonal windows here in terms of market action, whether it be in equities or in commodities. So there's lots of opportunities for us to pass along to people as places that they can put their money for either short-term or intermediate-term positions.
And the stock market's had a bit of a pop this week.
Yeah, a bit of a pop the last couple of weeks. I think we had that 9 consecutive day move into the middle of a week ago, and then a little bit of a pause midweek this week, but finished the week off well. The extent of this rise has really been good, and it came off a very important cycle lows there right at the end of October. Got some cycle lows as well as some of the technicals that we look at, and the correlations that I like to do with other markets or other time frames. There are a dozen or so examples that are similar to this one that come off the low in dominant uptrends such as this, and they get back up, retest the highs, and the style of action that we would anticipate here is that you probably get into a more choppy action as we go through the next month or so, but still having an upside bias, and especially from this weekend through the Thanksgiving, typically the days before and 3 to 4 days after Thanksgiving are pretty good for the equity market. So for the short-term traders, the opportunities to take advantage of there, and then hopefully a bit of a more of a pause into mid-December. And then you can be looking for the second part of the season on the Santa Claus rally. Ideally, you want to be looking for a short-term oversold condition somewhere around the 9th to maybe the 20th of December. We look at the relative strength index there, and if you get a nice pullback in the RSI, that becomes a good entry point to take you in then through Christmas and into the new year. So short-term opportunities probably going to present themselves and in the equity markets, and might as well take advantage of them while other people are sitting back and just waiting for Santa Claus.
Anything going on with gold?
Yeah, this was a really good week for gold. It had corrected 38% of the run-up from the lows that we saw back in the summer. It was a pretty good move on the upside to 2,000 or just shy of 2,000, and then backed off. So 38% was going to be an optimum level for retracement. We saw that in the middle of this week. We also had one of our sequential nines that we look for. That's 9 consecutive days with prices closing below 4 days earlier. And that kicked in right on the low close here on this correction. The rally now has made it back about Fibonacci 62% of the decline. And, the overall here is that we're of the mindset that this is setting up for the eventual breakout through 2,000. And wouldn't be at all surprised that we've seen that sometime in December, January. This structure that we have going back over the last couple of years, this big triangle with the resistance at 2,000 appears poised to resolve itself on the upside. And not only gold been moving recently, but the silver market managed to have a pretty decent week here as well. Ended up with the best prices we've seen in many months as far as the silver is concerned. So look for that to have a bit of a breakout, and anything maybe through the $25 range, and you'd be probably looking at $30 silver.
What's going on with crude?
Crude got down a week ago into what we thought would be a decent support area, had a small bounce just into the $79 range, and then middle of this week took another break, did kiss down to 73 3/4, but overall looks as though from a cyclic point of view, a pricing point of view, we should see an interim low here, probably bounce back into the low 80s. 80 to 82 would be reasonable, I think, at this point. This is all part of what I think is a broad consolidation that still can take us into maybe next second quarter of next year, sort of this broad trading range. You don't want to get too excited either way. You buy the hard breaks, then sell them into the good rallies, and the stocks have been underperformers here in the last month or so, and so once again you probably treat that the way you would the oil itself, as a trading vehicle. Unless you've got some of these ones that have got the good strong dividends in them, and on that basis you might want to sit around and just enjoy the coupons that you're getting.
What's going on with the U.S. and Canadian dollars?
Okay, well, the U.S. dollar broke down early in the week. We got down to 104. Didn't manage to get much of a bounce at all, and we've got interest rates in the U.S. starting to ease down, and that's taking some of the bullish underlying support away from the dollar index. The Canadian dollar has been bouncing around with the oil market. Had a decent week this week, but it's really doesn't seem to be in anything other than a trading range right here with a lid on it. Maybe call it 73 1/4, but downside bias is still there, and it probably gets down definitely and not only retest the $72 low that we put in at the early part of the month, but probably sees that taken out.
What's going on with uranium?
Uranium, been like this one for a number of years. We had that big run up into September, October. Got overbought. It was really in need of a correction, and we were looking at the 20-week or the 50-day moving averages to be support on a pullback. That happened here about 2 or 3 weeks ago. And if we take a look at things like the relative strength index, it got back into neutral territory in the mid-40s, and then things have come to life again. The uranium price itself is pushed up to multi-year highs around 77.30, still a long way from the highs we saw back in 2007, but this is a pretty good move. And if we take a look at the big names here, the ones that have been around for a few years, they pretty much all managed to put in new highs for the year as of this week. Good breakouts, and the action has been similar to the bull market we saw back in 2003 to 2007, and we're probably maybe a halfway through that type of rally at bull market. So what you look at here is that the breakouts out of consolidations like this, you can allow for pullbacks that test the breakout. You don't want to see much in open overlap. In this case, the lows that we had right around November the 7th, which is the last pullback before this breakout, that would be the maximum that I would want to see the uranium stocks come back. So you can have, therefore, some reasonably tight stops, still enjoy the move on the upside, and you never know where these things go. Once markets gain some momentum and the trend's up, then at this point the old highs from back at 2007, not too many people that are holding on to those old positions. So the overhead is pretty much free here for anything to run as strongly as it wants to.
Ross, again, how can people sign up for your special?
They can go to the website, which is chartsandmarkets.com, and that's 25% off the annual subscription, good through the Thanksgiving weekend.
Ross, thank you so much for the update.
Thanks, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Find him on X at Charts by Ross. Coming up, Eric Hadik, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Eric Hadik, CEO and President of InsideTrackTrading.com. He's speaking to us from Central California. Welcome back to This Week in Money.
Oh, thank you for having me back, Jim.
Eric, let's start with a little broader perspective. What is your 6 to 12 month outlook for interest rates, and why did you think October would be the time for the bottom for bonds?
I'll start with the second half of that question. Okay. And as far as a potential October bottom in bonds, it was the synergy of a lot of different factors all coming together that really convinced or are convincing me that that bonds should have put in a multi-month low in late October. On a much broader perspective, I've talked about a pretty consistent 4-year cycle that timed recent highs in July of 2012, July of 2016, July of 2020, and I think we're going to see something similar in July 2024. But there's also been a pretty consistent 5-year cycle between lows, and it's a little bit like a 5-year cycle that I've talked about inversely in crude oil that has timed some important highs. But this 5-year cycle in bonds last set a low in October of 2018, and prior to that in fourth quarter of 2013. And so although I don't always expect it to land on a precise 5-year basis with a cycle that's that broad. October 2023 was the exact 5-year point from that low, but there were other cycles corroborating that and coming into play. There's even been a kind of a 360-degree or 1-year cycle that has been creating successively more significant bottoms, first in October of 2021, then October of 2022, then October of 2023, or at least that's when I was expecting it. And kind of more significant than that to me is how some of the other cycles are breaking down and pinpointing the same thing. There's been a approximate 18-month cycle that has timed successive highs in bonds, and the last one being in January, February of earlier this year. The next one coming due in middle of next year. And one of the things I was looking for was this particular cycle to kind of split in half, both in price and time. And that being, we see a decline for the first 9 months and then a rebound for the subsequent 9 months, but also something that would be similar in magnitude, the decline and the rebound. And that was also pinpointing this October time frame. But anyway, I don't want to belabor that. There were also some other wave characteristics that were saying bonds were really due for a pretty significant bottom. They've traced out a very classic textbook 5-wave sequence from their mid-2020 top. And in September, they finally set new lows for that sequence, which was the minimum needed for a 5th wave decline. And so there were price factors also showing that it was due. And so from that, and going back to the first half of your question, I think that bonds are going to see a slow but steady recovery between now and the middle part of next year. And so interest rates see a little bit of retracing or tailing off a bit. And really that we'll see a trading range in 2024. But if we do get bonds rebounding into July of next year, and if we have hit and held some key resistance levels, it's kind of what comes after that I think is the bigger concern for bonds, for interest rates, and a lot of that could have an impact on or be a consequence of things other than just inflation.
Does that have an impact on what you expect for the U.S. dollar?
Yeah, and that actually is one of the key factors I'm looking at. I've been explaining why the dollar fulfilled multi-year and even 1 to 2 decade upside targets when the dollar index got up to 113 back in late 2022. And so I've been talking about just this topping process that I thought we would see in the dollar index throughout 2023. And then you start to curve a bit more to the downside in 2024 and probably accelerate a bit to the downside in 2025. There's specific time frames when some of those moves and shifts are most likely. But I do think that is going to be one of the key factors that impacts interest rates and bonds out from 2025 and on. And I think there are just so many signs showing that the U.S. dollar is at a significant top, and you're seeing more and more fundamental signs creep up to anyone that's paying attention that you've got more and more pressure to compete with the dollar as the global kingpin, the global currency, reserve currency. And this whole kind of movement of even something like a petro yuan to compete with the petrodollar is something that, to me, just the perception of it. I know when you start to really dive down into the reality of a full-blown petro yuan, to where oil is priced and traded in yuan and other currencies, that there's a lot of factors that still favor the dollar. But if you took, the dollar being the 100% reserve currency and petro currency for 40 or 50 years and shifted that to 90% or 80%, that would have a major impact on the dollar itself. So it's not that you're going to see the petrodollar suddenly disappear, but as you get more and more, not just countries, but unifications like the BRICS, like the Shanghai Cooperation Council, like there's actually probably 10 or 12 of them, many with overlapping members, that continue to develop around the globe. And some of them, like BRICS, is certainly there with the objective of trying to unseat the dollar as the global reserve currency. And so I think that the technicals and the cycles are showing something similar in the dollar, to where I do think that 2024, 2025 are going to be bearish years for the dollar, and that could have a big impact on bonds and interest rates out over the next 2 to 3 years and beyond.
Earlier this year, you started describing what you call the developing sweet spot for silver. Can you update us on silver and its so-called sweet spot?
Yes, what I described with that was that within a broad inflationary period, you get this particular time when it's much more favorable for precious metals and other factors that are inflation related, but have a love-hate relationship with inflation. And how I explained that, really even starting late last year, but when you have inflation coming, you had gold and silver go through a 5-year uptrend from late 2015 into late 2020, and then even kind of spiked back up in early 2022. So in many respects, that was more a precursor of the inflation that followed. But you get so many traders thinking, well, if inflation's strong, then gold and silver have to be going up. And that's not usually the case through a large percentage of that cycle. And the reason is, one of the big reasons is, that as soon as you get the Fed and the other powers that be recognizing that there is inflation developing, they start using interest rates in particular as a tool to try and combat that inflation. And rising interest rates are typically a negative for gold and silver. And so as you saw a lot of this inflationary phase in 2021 and 2022 unfold, you actually saw gold and silver under pressure for big chunks of that time frame. The good news for gold and silver bulls is that pressure they experienced still kept them in a much higher plateau, kind of biding time until their time to shine came back into focus. And so starting late last year and then earlier this year, I described how you're now entering that time within a broad inflationary and economic cycle where you've got inflation still in the markets, in the economy, And even though some indicators have shown that it has peaked or its upward acceleration has peaked, which is a much different thing than the inflation actually peaking, you start to get the perception, too, that the interest rate hiking cycle is nearing completion, at least for a particular 6 to 12 month or 1 to 2 year period. And so that starts to remove the big weight or the big burden that has been keeping gold and silver under wraps, even though those upward inflationary pressures are still there in the market. And there's other factors, too. There certainly are factors that are increasing the potential demand for silver over the coming years. And so I described why I thought silver was entering this sweet spot and that we would see a big surge starting in October of this year. And once we got that initial surge, silver pulled back a bit. And just in my very recent November 11th weekly relay, I explained why we had pulled back, and now silver was at some critical support right around $22. And that from a wave perspective, that is identifying what could be the third successive low. And anyone familiar with Elliott wave, there's kind of a pattern called a 1-2-1-2-1-2, which is setting up for a pretty strong rally. And that 1-2 and 1-2 and 1-2 are different magnitudes of developing waves. So you get an initial rally, a pullback, a smaller magnitude rally, pullback, a smaller magnitude rally, pullback. And now it's ready to enter what is the third of the third wave to the upside, which is typically your accelerated wave. And so between November 13th and mid-January, much of my cycle work is showing a pretty bullish time for silver when it could see a pretty good surge as part of this overall sweet spot. And I think there still is far more upside coming into 2024, and I discussed that separately, and that's a whole additional discussion. But I do think that silver is in this very favorable setup, not just for the immediate future, but for the coming months and even 1 to 2 years.
So far, your prediction for crude to top in mid-September is holding firm. What do you see ahead for oil?
Yeah, I was just alluding to the 5-year cycle when I was talking about bonds and having a similar 5-year cycle. But one of the things that prompted me to project that mid-September peak in crude, and that being at least a 3 to 6 month peak and potentially more than that, was a recurring 5-year cycle in crude that came into play then. But there was also a lot of monthly and weekly cycles all coming into play, and as they were on the horizon in April, May, June, I was explaining why we should see a surge into mid-September and why crude should get back up to the $86, $87 level before a top would come into play. We finally got that action taking hold, and crude kind of set up the perfect price and time scenario for a multi-month top then, and has been steadily turning down since then. Most recently, it has it turned its weekly trends down. That's an indicator I use. It's a little bit more of a lagging and confirming indicator. But that, along with some other factors, is telling me to look for a final spike down in the short term. So during this week in mid-November, perhaps carrying over a little bit into next week, Thanksgiving week here in America, November 20th to the 24th. and that then crude could probably see a rebound into the middle part of December is what I'm looking for right now. And so there still are some downside targets that need to be reached in crude before I think that a multi-week bottom could take hold. But it's all part of a topping process that's going on in the energy markets. And there's also some of your energy stock indexes, your XOI and the XLE ETF, that are showing some real signs of a developing top and starting to pinpoint when and where they could see some pretty significant sell-offs in the not-too-distant future. So crude is certainly validating that those mid-September cycle highs and showing that we should get a final spike low here down towards the $70 a barrel level. But it could find support here in mid-November and see a rebound into middle part of December.
You had some interesting observations on cycles you think that are impacting China. Can you elaborate on those?
Yeah, that is a whole collection of different cycles that I've been discussing, both military cycles, economic cycles, and it's just been very interesting to me how they appear to be coming together in 2024, 2025. I even detailed in my latest Inside Track where there are some long-term cycles, 40-year cycle, 70-year cycle, 80-year cycle that have governed certain events for the PRC and the ROC, basically China and Taiwan, and that they are coming together in the coming years, and that those cycles really, for me, pinpoint 2024, 2025 as some initial, what I think will be initial conflict, and something more significant looking out at a specific time, a couple years after that. But at the same time, I've been talking about cycles in the yuan that I thought were looking for a bottom here in late 2023. And one of the things that I just, with many of the things shaping up for China economically and militarily, I was just making a little bit of an observation as far as parallels that China in the recent decades has had to America going back in the last century, and kind of it's all in sync with this 40-year cycle and the broader overriding 80-year cycle that I discussed so much. But I was just kind of showing the parallels, how if you look back over the last century, 80 years ago was, or excuse me, starting at an 80-year increment, you had in the 1920s, you had the U.S., and from stock market perspective, its real heyday in the 1920s. And China had something similar in their stock market in the 2000s, 80 years from America's roaring 20s. Back in 1920s, that bull market lasted approximately 8 years, and saw the Dow's value multiply about 6 times from its low point. Well, the SSE in China saw the same thing, about an 8-year rally that took it to about a 6 times multiple its low value in the 2000s. After China's market peaked in the late 2000s, suffered a year-long crash similar to 2930 in the U.S. 80 years prior. In 2012, China's stock market began another solid multi-year advance just as America's index had done 80 years earlier, beginning in 1932. More recently, we've had China's index go through a multi-year sell-off that lost about half of its value from its most recent peak, and it bottomed in 2022, and that was 80 years from when the Dow bottomed a second time in 1942 after losing half of its peak value. So you kind of have this parallel, this comparative structure with an 80-year separation of what China has been going through now and what the U.S. and the Dow went through 80 years ago. And there's some conclusions that I've drawn from that moving forward that are corroborated by a lot of other factors. I always emphasize it's got to have the synergy there to even be worth discussing. But it creates an interesting scenario for the coming years. And I think that China is going to begin to see some greater influence and influx of investments at some specific times over the coming couple of years.
Is it important that we keep an eye on China's success or lack of success? Because we know countries, when their economies get into bad situations, often revert to war because it takes the population's mind off of the economic suffering they're going through. Do we have to worry about that in China and their eyes being on Taiwan?
I think that is certainly a factor, and you keep hearing about the kind of the balancing act that Xi Jinping needs to play between his domestic populace and the Communist Party, and also how his relationships with the U.S. and other major partners is concerned. And so I think it's a little different than just an all-out kind of dictator type of scenario like the one you're describing, where a faltering leader suddenly needs to get an outward distraction. And I think that China has so much to lose economically that I think things are a bit more calculated and methodical than that scenario that we've seen play out different times over the last 100 years. And I think in contrast to that, if you look back over the last decade, you've seen China very, very methodically, very meticulously getting their ducks in a row. And part of that is with these different economic unions. Most recently has been, over the last year or two, how much influence they're starting to wield in the Middle East, and the treaties, or at least agreements, between Saudi Arabia and Iran, and trying to play roles between other nations there, and also getting places like Russia to agree to price oil in yuan. That was something that initially happened back in 2017. But you've got kind of an enemy of my enemy is my friend relationship that keeps going between China and Russia. And so I think China they're a competitor, and they are competing very methodically, very meticulously. And I think that some of their efforts are going to start to come to fruition in the coming years. And so that's more what I'm focused on.
Eric, can you give us more information on Inside Track and how people can sign up for that on the weekly relay?
Yes. Inside Track is our monthly newsletter. Weekly Relay is a weekly publication with intra-week alerts as well. We provide analysis, technical, cyclical, and to a lesser degree fundamental analysis on most of the key markets, discuss different approaches, trading strategies, risk points, objectives within that analysis. And the best place for listeners to locate a lot of information on our different subscriptions, but also a lot of archived publications and samples to give them a much better idea of what we provide is at our website, InsideTrackTrading.com, and that is inside spelled with the extra I in the middle, so it's INSIIDE, tracktrading.com, and they can find a wealth of information there.
Eric, thank you so much for being on This Week in Money.
Thank you for having me back, Jim. It's been my pleasure.
My guest has been Eric Hadik, CEO and President of InsideTrackTrading.com. Coming up, Robert Campbell, next on This Week in Money.
RecycLiCo, making lithium-ion last forever. RecycLiCo's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. RecycLiCo Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMY.ZF, and Frankfurt ID4. For more information, visit RecycLiCo.com or phone us at 778-574-4444. RecycLiCo, making lithium-ion last forever.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Robert Campbell, publisher of the Campbell Real Estate Timing Letter at realestatetiming.com. He's speaking to us from San Diego. Bob, welcome back to This Week in Money.
Thank you very much, Jim. Glad to be here.
When will the next issue of the Campbell Real Estate Timing Letter be published?
In the next couple of days. I'm doing the finishing touches on it right now, and that'll be the November 2023 issue. I publish it every 2 months.
Is now a good time for people to read your book, Timing the Real Estate Market?
It's always a good time to read good books about timing anything. But especially now, because we're engulfed in a bigger real estate bubble here in the United States. It's of greater dimensions than it was during the last real estate bubble that peaked in 2006. All the metrics show it is that housing is more expensive, and more expensive than it was back in 2000 at the peak, and 6 at the peak, and it's also less affordable. And that's a key term that people throw that term around, saying that affordability, like it's just, yes, that we need to get homes more affordability, but they don't realize how affordability swings from very unaffordable to very affordable over time, and how that if you could look at those ups and downs on a chart going back 50 years, you'll see that they correlate very nicely with the peaks and valleys of real estate cycles. So that's why I focus on it. You just can't say, oh, real estate's unaffordable, but, there's no supply, so we're okay. No, that's not the way to look at it. The way to look at it is that when housing gets super unaffordable, and we're at record lows right now, what happens going forward? Real estate crashes go from boom to bust. And all of a sudden they go lower and lower and lower. And then what happens? Housing gets affordable, by the affordability metrics. Then what happens? Housing reverses course and starts going up. So that's a cycle as predictable as summer and winter. You just have to look at the charts and say, wow, this is what happens. That I always tell people that my views are simply a result of what I observe. I don't speculate about anything. One thing I can say, because what you observe over time, whether it's the existence of cycles or the ups and downs in real estate market, it's all about what you observe. So the better you can observe these and pinpoint the tops and bottoms of these changing cycles, the more successful you're going to be in real estate.
What leading indicators do you follow for home prices, and how do they work?
I wrote a book called Timing the Real Estate Market back in 2002. I'm starting my second book because I've doubled my knowledge or tripled my knowledge since then. But in my first book, Timing the Real Estate Market, I identified 5 key leading indicators to price change in the housing market. And these were all identified according to objective data, knowing the price cycles, looking what these indicators did over time, and that the 5 indicators are as follows. Number 1, existing home sales. Number 2, new home building permits. Number 3, notice of defaults. Number 4, foreclosure sales. And number 5, interest rates. And if you track those key indicators that, as closely as I do, and look at them on a monthly basis and do some statistical analysis on them, when they change from up to down, that means housing prices are more likely to go down than up, and vice versa. So, yeah, and they're as accurate today as they were when I identified them over 20 years ago.
Can past real estate cycles help predict what's ahead for the real estate market, both short and long term?
Well, it depends how you define short and long term. Typically, here in the United States, at least when you adjust real estate home prices for inflation and then look at it on a cyclical basis, historically, since about 1970s. Real estate in the United States goes up 6 months, goes down 6 months. Up 6, down 6. Up 6, down 6. Now, the current market here in the United States, based on that 6-year interval, not 6-month interval, was scheduled to start heading down back in 2019. But then COVID hit, and the whole world turned upside down for some crazy reason, and real estate during the COVID years went up 30 to 40% during that 2-year period. So now we're at the 8-year cycle, and it looks like it's starting to head down again, based on my most recent analysis.
During periods of credit constriction, can home prices move higher?
Home prices can do anything, but typically, no, they don't do that. And there's another cycle for you. And this cycle can be explained as all follows. It's availability of mortgage credit. When housing prices are on the rise and going higher and higher, that mortgage lenders loosen up the standards for making loans, because they're as guilty as humans are. The prices are just going to keep going up forever and ever. So in other words, near the peak of the market, they're going to have far looser standards than they are at the bottom of the market, where they're going to be most restrictive. And I'm writing about that in this current issue. The Mortgage Bankers Association has created an index of that going back, I think it's back to 1995 or so. And it's the Mortgage Credit Availability Index. And you can watch the cycles. Mortgage availability is really loose near the peak, and it's really tight near the bottom. Interestingly, that even though cycles tend to repeat, they don't repeat exactly. What's happening right now, even though housing prices are very, very high, at all-time highs in many instances, the availability of mortgage credit is very tight right now. It's almost as tight right now at the peak of the market as it was back at the bottom of the market in 2012 when housing prices bottomed in the United States. So that's an interesting data point right there, because you go, wow. In other words, as much as lenders, and here's how you can explain it, as much as lenders are tightening their standards right now, that they know housing prices are high, the reason prices are still high is there's only one word. It's supply. Lack of supply. There's no houses on the market. But that's changing right now. That based on my analysis, that's pivoting right now, even though it's been that supply on the market has been going steadily down into record lows. Record lows. How many on the market? It looks to me like the inventory of homes for sale on the market is pivoting higher right now. So while the demand for homes via existing home sales is starting a new leg down. So based on that, I anticipate that home prices are going to start going down again and take us into the next cyclical low, which I expect to occur sometime around 2028.
With the substantial increases in mortgage rates, how are people affording to buy homes these days by taking out a mortgage?
Well, they're not. That's why home sales are down almost 50% from their peak 2 years ago. People can't afford it. There it comes back to affordability. The average home on the market right now, what it takes to qualify for the median price home in the United States right now requires, at today's interest rates, requires an income of $115,000 a year. Household income, $115,000. What the average income is, household income in the United States, is approximately $75,000. So in other words, the median price home is priced 53% higher. It's priced 53% higher than most households can afford. That means in order to get back to any kind of normal affordability, not everybody can afford a home. But normal affordability levels, household income has to rise 53% from current levels. That's a record, guys. That's how unaffordable this housing market is.
Have you studied the psychology of buyers and sellers during a real estate cycle?
Oh, of course, because that's what drives the cycles. It's always fear and greed. It's always fear and greed. I've talked about that, multiple times on these interviews, Jim. It's what rules the world. People get too greedy about anything. Their net worth, what their home's worth. When things are doing well, and then when things are going bad, they get too fearful, which of course drives housing prices, makes the markets even worse. But it's the nature of markets. It's the nature of fear and greed. Those are the two driving forces. And that it's interesting, even though a couple people have written books about that and received Nobel Prizes for behavioral economics in that, most people don't understand it and embrace it as well as they should. Even though it's hard to quantify fear and greed. It's not like a number. The only way you can read the numbers is like, what do prices do? When prices get to the point they are right now at exceeding the old record bubble highs by a 10 or 15% margin, is that a sign of fear or greed? It's a sign of greed. Of course it is. But can you quantify that to say, okay, when greed gets to a reading of 95, it's time to sell, or when fear gets to a reading of 95 on the downside, it's time to buy. People have tried to do that over time. But you know what? It's a lousy timing indicator. You have to use other indicators like the ones I specify in my book, to get the cycles down. But fear and greed, that's the driver.
Historically, do wars in the Middle East lead to higher crude prices, which lead to higher inflation, which lead to higher interest rates?
Yep. It's sure not happening right now, though. All of a sudden, we got a raging war in the Middle East, and oil prices are down to $73 a barrel. Nobody would have expected that. But historically, here's what happens historically. Why we are, that I'm still convinced that we are in a inflationary cycle that's going to last a long time. Several reasons. First, U.S. deficit spending. The U.S. is currently spending $2 trillion a year more than they take in tax revenues. So we're running $2 trillion deficits. And we're running $2 trillion deficits not during the middle of COVID, where they're shutting down every other business right and left. We're running a $2 trillion deficit during what will be called, solid, strong economic times, where GDP in the U.S. just went up, almost 5% year over year. Unemployment is near record lows. And if you have to run a $2 trillion fiscal deficit to get those numbers, heaven help us, because deficits are inflationary. And also now we're in a wartime economy. We're fighting wars in Ukraine. We're fighting wars in Israel. Wars are being threatened. Who knows where else the U.S. is going to go, start a new war and fight it. But we're in a wartime economy. So if you go back and look what's happened, during inflation, during wartime economies, such as during World War II and the Vietnam War, inflation roars. And what happens when inflation roars? Mortgage prices go up with it. So that's why I think this is just a little bit of what we're seeing right now. If it's not completely manipulated by the U.S. government and the Fed, which it probably is, which I haven't been able to figure out, of course, to my desire, but most likely we're going to be in back. They're going to keep running these huge deficits, fighting these wars, and inflation is going to stay with us and go up, and so are mortgage rates. These numbers, by the way, here in the United States, we just you know what the U.S. is doing to keep the rate of inflation down? They recalculated how they did the inflation formula. Now they're changing how healthcare costs are calculated. According to the government, healthcare costs have gone up about less than 1% in the last year. 1%. And people that are in the business of providing healthcare insurance policies to businesses, I mean guys that have done, that do 300 or more policies a year to businesses, they're quoting 1%. My average increase in healthcare policies is between 10 and 15%. So that's how unrealistic the government numbers are, guys. So, you can just stick your head in the sand and say, this isn't happening, this isn't happening, this isn't happening. But eventually, the guy on the street that can't afford food, that can't afford rent, that can't afford health care, that can't afford gasoline, and of course can't afford a house, unaffordable, tell him that there's no inflation right now.
With the rising U.S. government debt, what does that mean for the bond market?
I mean, bonds are going to keep going down because inflation is going to go up. The interest on the national debt, $33 trillion, $34 trillion, I don't know, it seems like it goes up $1 trillion every 45 days or so, just exceeded $1 trillion a year. In other words, servicing this increasing national debt, the debt on that, based on today's interest rate, is now greater than the amount of money that the U.S. spends on defense. And the amount of money that the U.S. spends on defense is the greatest. I think that I know we're the greatest in the world, but I think our defense budget may exceed most every country in the world, even combined. So that's why we're getting into a debt spiral here, everybody. The national they have to keep borrowing money, more money than they bring in, $2 trillion a year. Put that on top of the national debt. Interest rates go up. You have to keep paying interest on that national debt, of course, or else you'll default on the national debt, and the whole system collapses. So now it keeps going higher and higher and higher, and pretty soon, if we're not there already, you have to start borrowing money to pay interest on the existing national debt. So in other words, the deficit spending could go from $2 trillion this year, to 2.5 next year, to $3 trillion the next year, and you go, why does it keep going up? Because you got to keep spending, you got to keep borrowing money to keep wheels on the car. And that's the position that we're in right now.
Generally, is higher inflation good for stock prices?
Yes and no. And the no answer to that is during the Vietnam War, the U.S. stock market did nothing. In fact, it went sideways to down for, almost 15 years. Where the stock market really shines is during periods of super high / hyperinflation. Like if you go back and look at, the classic hyperinflation, Weimar Germany, during 1921 through 1923, two asset classes that held their purchasing power during that period of time. One was gold, and the other one was the stock market. Because the society, even though how tough it is, it has to keep functioning. I don't care if material costs go up, 1,000% in a year. The 1,000% increase in material costs gets reflected in the prices that you charge your customers. And if it's for essentials, like rent, energy, electricity, food, it all gets reflected in the cost that the consumers need to pay. And so, in other words, everything is spiraling upward, wages and everything, but the stock market holds its own better than anything else, with the exception of gold. So could we get into that situation? Yeah, we could get into that situation where it's super high, and it can happen really fast. For example, Argentina, the rate of Argentina was experiencing 40% inflation approximately a year and a half ago. Today it's at 140%. It went from 40 to 140 in a year and a half. That's how fast things can change, folks. Now, can the average guy keep up with that? No. You have to be positioned ahead of time, that you see it coming, get out of the Argentine peso, get into a different currency like the U.S. dollar, get into gold, get into silver, buy food, buy stocks. I don't know how the Argentine stock market's doing right now, but my guess would be that it's, I don't even want to guess, because it's not hyperinflation yet, but that's how fast things can change. They said that, okay, inflation, the official rate of inflation according to the government is 70% a year. Real world, it's double that. It's 140.
Yeah, in Argentina, and they think it'll be 200% by the end of the year.
Well, that's certainly the trend, Jim.
Yeah. Definitions of recessions and depressions seem to keep changing. What kind of shape is the U.S. economy really in?
Well, as long as we keep spending $2 trillion, more than we take in taxes, that's very stimulative to the economy. It's hard to imagine that we can have a recession when you overspend that much. I mean, so it appears that all the traditional recession indicators that have been reliable in the past and have been giving alarm signs, for the last year and a half, none of it has worked out. The yield curve's been inverted for a year or two. That's your best indicator right there, where the 30-day T-bill rate exceeds the 10-year rate or the 30-year bond rate. That's been inverted for well over a year. No recession. Other indicators that leading indicators for the United States. It's recession warnings everywhere, and we don't have a recession. And it's my view that as long as we keep spending 50% more than we take in tax revenues, there doesn't have to ever be a recession again. I mean, ultimately, what's going to happen? Ultimately, inflation is going to go off the scale to the upside, and things are going to crash. But, is that right now? Hasn't happened yet. But that could happen at any time, as long as we keep up with this deficit spending. And the Federal Reserve just almost has no choice but to go along with it. So, in order to balance, people keep talking about balancing the budget. We need to stop this fiscal madness. Balancing the budget. In order to balance the budget right now, I believe that we would have to decrease government spending somewhere in the range of like 6 to 10%. If the government cut their spending back by 6 to 10%, we wouldn't be in a recession. We would be in a 1930s depression. Because the whole system is built right now on the fact that everything is going to stay in place, that there's going to be money put into the system, new credit's going to be emitted. So do I think that the budget is ever going to get balanced? No. I can almost promise you it's not. But at some point in time, the realities of spending, 50% more than you take in is going to catch up with you, and either the economy is going to go into a depression, or the U.S. is going to default on its mortgage obligations, and the currency is going to be lost.
We keep hearing about people leaving California. Is that having any effect on California real estate?
A little bit. I mean, California real estate seems to be that some areas, especially in San Francisco, is underperforming the U.S. market. Other markets, however, where I live, surprisingly, San Diego was one of was that back 6 months ago. It was a weak market heading down. Now it's developed newfound strength, and it's one of the strongest markets in the United States right now. San Diego, California. And I'm not just saying that because I own a home in San Diego. I could care less what the value is at. In fact, I wish all these homes would go to zero, because I have enough cash in the bank, I'd buy a ton of them up at the bottom. But San Diego is a super strong market right now, by my indicators. And I don't know how to explain it. Like I said, my views are driven by what I observe, and that's what you observe. Prices are going up. We're building new homes like crazy in this market. I mean, I can't believe it, with affordability being so low and the fact that construction costs are so high. What's driving the market higher is the new home building permits. So, it is what it is. But do I anticipate that this, that what's going on right now in the in San Diego or maybe other parts of the country that are still strong from a real estate standpoint, will this be the beginning of a new upleg in housing prices? No, not at all. You'd have to be a fool to buy into this market right now. And if you don't believe me, if you just want to convince yourself, which you should, in the September 2023 issue of my timing letter, I showed Yale economist Robert Shiller's 130-year chart of inflation-adjusted U.S. home prices. And you go starting at about 1970, you see 6 years up, 6 years down. 6 years up, 6 years down. Well, right now, here where we are in 2023, we are about 8 years up. For somebody to say that we are on the cusp of a new upleg in housing prices, you're saying 50 years of history don't matter. And that's a very, very bad bet to make, folks. Very bad bet to make.
What are some of the biggest mistakes real estate investors make?
Some of the mistakes? Well, what they do is that they believe the hype, and they extrapolate whatever the current trend is into the future. And you can't do that. So when prices are rising, they're always bullish. And then when prices are falling, they're always bearish. And that's why you got to overcome that emotional, the emotions of fear and greed. You have to, for anybody to be outperforming the markets, I don't care whether it's stocks, which isn't my thing, but real estate is, you have to overcome those emotions. You have to overcome the tendency to follow the herd when everything looks good and looks like it's going to stay good forever. In other words, when the market gets euphoric, at the euphoric stage, you have to be looking on getting out of the market. And when the market looks worse, when everybody's depressed, fearful, jumping out of buildings, that's the time you got to get in. Is that easy to do? No, it's not easy to do. Is it easy to get rich in this world? No, it's not easy to get rich in this world. And that comes from somebody like myself that's 76 years old, that's played the markets my entire life. having more wins than losses, of course, because I feel like I'm I'm smarter than your average bear. But is it easy? No, it's not easy at all. So you gotta get geared up and saying this is going to be a fist fight all the way through. I mean, it doesn't have to be, where it's going to affect your health or anything, but you can say it's a battle for investment survival that you're going to have to fight your entire life. And unless you're willing to take that challenge, you're not going to be nearly as successful as you could.
Any health or fitness tips for us?
Yeah, I want to go over a basic thing that it's probably that the number one tip I could give somebody for being healthy and fit. Let's say healthy, not so much fit. Well, because if you do this, you're going to be fit. It's to avoid certain kinds of foods. The two types of foods that you can take a quantum leap forward in the condition of your health, if you just avoid seed oils like safflower oil and canola oil and all these things they put in fast food and everything like that because it's cheap, and also if you avoid fast carbs. And what I mean by fast carbs, anything that has anything to do with wheat. Anything. I just finished a book called Wheat Belly. And that you can almost eat anything you want, as long as it's not seed oils, and as long as it's not wheat. And I mean, you can't eat donuts, of course. You can't eat bread. But I can eat as much protein as I want. I can eat as much cheese as I want. I can eat as much nuts as I want. But you have to avoid the fast carbs. And there was a bunch of recipes in that book that are really good because, when you're on a strict diet, your diet gets really boring, guys, really boring. So I like pizza. I mean, typically you go to a pizza place. Is that on the list? No, because it's made with wheat. So my wife found out they had a recipe in there how to make pizza without using fast carbs. And I'm not sure exactly what they do. What the crust is made of, from what I understand, it's like almond flour and maybe, finely ground up walnuts. And of course you can have all the cheese and you put pepperoni and sausage on there. And you can't tell the difference between that pizza and the pizza you buy at a pizza place. The only difference is that you can mac on those things all day long, and it's not gonna negatively affect your health, like give you insulin spikes and that kind of thing. So there are things you can do. And so what do I do? What do I use for dessert? What she's making me now? I use things like you can eat all the vegetables you want, of course. And broccoli and cauliflower are two of my favorites. So she goes and buys broccoli and cauliflower, steams them, puts them in the refrigerator. I take them out, put them in a pan, and just cover them with butter. Put them in the microwave. The butter melts, and those things are just soaked in butter. They have no negative effect on your health, and I swear to God, it's the best dessert in the world. So you can change your diet, guys. You just can't use fast carbs anymore. Are broccoli and cauliflower carbs? Yeah, but they're vegetable carbs. They have net carb value. Those things go through you like crazy because they're fiber. And you could eat broccoli all day long, and even though it's a carb, you'd never gain an ounce. You never would. So that's the kind of things you want to do. So if anybody that is interested in really changing their diet for the benefit, and have somebody make recipes for them that are tasty, that fits in with that diet, buy the book Wheat Belly, guys. I mean, it's not a bro science book. It's written by a doctor who studied this over time, and I know there's lots of different ways of staying in health, your diet. I mean, I think it's pretty close to what's called the Mediterranean diet. I mean, all these good diets aren't black and white different. But what I liked about this is they gave you recipes where I can eat pizza. Who doesn't like pizza? But is pizza on the list of healthy foods? No, it's not. It's terrible because it has all that wheat flour in the crust. But now I can eat it, and I feel better, and I'm getting my weight back down. I had an athletic accident about 6 months ago where I haven't been able to go to the gym. I'm still into recovery, and I put down about 10 pounds. And since I started this diet, it's gotten me down. I only have like 5 more pounds to lose, and I still haven't been able to go to the gym. So diet, you can't outrun your fork, guys. You want to lose weight, it's all diet. You can run all day, marathons all day. Now, maybe that's a little extreme, but you can work out all day. But if your diet is crap, you're not going to lose weight. You're not. You're going to gain weight. Eventually, it comes down to your diet. Only thing that physical exercise does for you, and that's really important, by the way, is it makes you look better and live longer. Look better and live longer. Keeps your muscles toned up. Because you want to look like a teenage kid, ideally. What are his muscles, or somebody in their 20s? They have strong muscles, they're lean, an athlete, but the only way to do that is lift weights when you get older. You're not going to maintain your muscle mass by not going to the gym. Walking's not going to do it. I'm sorry. You got to do something physical. Lift weights, sprint, something like that. But you do all those little simple things, everybody, and you have a chance.
Bob, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Robert Campbell. His website, realestatetiming.com. He was speaking to us from San Diego. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Eric Hadik, and Robert Campbell. And thank you for listening. Now stand by for a company showcase update from RecycLiCo CEO Zarko Meseldzija. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HouseStreet.com.
I'm Jim Goddard. My guest is Zarko Meseldzija, Chief Executive Officer of RecycLiCo. Welcome back to Company Showcase.
Thanks for having me, Jim.
What's the latest at RecycLiCo?
Well, it's been a busy week, but I did want to take a few minutes of your time today to address a few key developments and questions from a number of listeners. Last week, I did attend the Benchmark Week in Los Angeles. This event, as many of you know, is a cornerstone in our industry, bringing together leading companies and thinkers in the battery industry. And we had the privilege of hearing from the likes of Stanley Whittingham, who's a Nobel laureate for the invention of lithium-ion battery. He shared a presentation, as well as we heard from Arnold Schwarzenegger, who I'm sure we all know as well. And he shared his thoughts on how we should terminate pollution and say hasta la vista to greenhouse gases. So I think the energy in the room was great, and just a lot of great conversations. But I think it was also encouraging to connect with those different leaders and companies who have valued our strategic approach to battery recycling, and who have been following us and working with us for a number of years. Their appreciation really underscores the importance of staying agile in our business strategies, especially in a dynamic market, which we've experienced year in and year out, going to these events and seeing how things change. But one key takeaway from the conversations I've had, and it resonates deeply with our mission, is the importance of staying agile in our business strategies. The market conditions are always evolving, such as commodity prices and new battery technologies, and it's crucial that we adapt and evolve with them while maintaining our core values and objectives. Now, this agility is going to be key to success, especially in a new industry, and RecycLiCo is going to continue navigating these opportunities that we see, year in and year out at these industry events, and we have the foresight of kind of what's coming next and what we should be expecting next. But with that, I'd like to also quickly, given I've talked about this a little bit, and I've talked about maybe a few times in the podcast as well, but I want to quickly address our business model and the long-term outlook, which we shared in our recent CEO letter this week. And I think everybody should, listening should, find that letter and use that as a reference of our company's plan going forward. What is our mission and which way are we going, right? If things don't seem right, read that letter for reference and then say, this is the direction we're going. And with time, things will get there. Because I think, in a dynamic market, it's natural to see, new technologies and we get questions all the time about how they compare to ours. But it's important to always understand the fundamentals, and that no technology or partnership happens overnight. So for instance, our press release this week, where lithium carbonate from recycled battery waste was successfully qualified through battery cell testing by C4V. This follows last year's success with our precursor cathode active material, both crucial products of our RecycLiCo process. And these achievements are going to be key to demonstrating our circular economy for lithium-ion batteries. And I think that's one of the fundamental truths is, there's no shortcut in making a lithium-ion battery work. There's specs, and you have to achieve those. And what we're showing is, our material is to that quality that the industry wants. We've also sent our product to a number of other companies, as we've announced before, and shared some of those qualification results, although many of those names are undisclosed. But keep in mind, this phase might seem slow, but it also allows us to be agile and to demonstrate our technology, to create samples more cost effectively. This is crucial for building confidence in our technology and forming joint ventures and building commercial plants in partnership. Because remember, the qualification process takes time, regardless, and sometimes it's beyond our control. But this is a necessary step in building these relationships with companies, and whether at our current scale or in a larger plant, we would still be going through these qualification processes. But in a larger plant, we would be investing more during this multi-year process. And this year, we've seen these strategies. We've seen some strategies play out, and I think this year especially, we've witnessed some significant shifts in the recycling industry, especially with large-scale strategies that really got out, right away in building plants and trying to process materials. Because now we're seeing many companies that are facing kind of project cost overrun and increased debt, particularly in a climate where capital isn't cheap. This can provide some challenges. And these challenges really highlight a crucial point, that the fundamentals of the technology and the importance of proper scaling and going the methodical approach, right? So there's really no shortcut in this field. And through planning and patience, those will be key attributes, as, rushing can just only lead to bigger problems down the line. And I do encourage, if you haven't already listened to my last podcast, where I discussed, those steps, those really critical steps in planning and design that we're taking for our joint venture with Zenith. I've received questions about after that podcast, I have received questions about the project timeline. And while I prioritize doing it right over speed, where things stand right now, our target is 2025. And of course, that's subject to change. but this is what we're targeting. We're also at the same time, also actively pursuing other joint venture prospects where, we're engaged in a process that includes that technology review, demonstration of our technology, material validation, and eventually, the negotiations and commercial planning. So as we've announced a number of these different stages, and some of these we're working on with companies. But this is kind of the general progression of building that confidence in technology and scaling it. It is a kind of that pipeline of work is a meticulous process, working with collaborators, right? But it is essential, like I said, for long-term success. So, again, if there are any more questions that come up, please don't hesitate to contact us at our office. I'd be happy to answer any questions as we continue doing podcasts.
Zarko, where are you traded, and how can people get more information?
We're traded on the TSXV under the ticker symbol AMY, on the OTCQB under the ticker symbol AMY.ZF, on the Frankfurt Stock Exchange under ID4, and you can get more information on our website, www.RecycLiCo.com.
Zarko, thank you so much for the update.
Thanks, Jim.
My guest has been Zarko Meseldzija, CEO of RecycLiCo. I'm Jim Goddard. Our conversation took place on November 17th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.